Okay, welcome everyone. Good morning. We'll start our second lesson. Today lesson will go through LO2, which is learning outcomes to understand financial management environment. So that's our learning outcome, understand financial environment. So which we'll discuss. Aim of this unit we already discussed. So what you know about now, sources of finance and monetary and fiscal policy. Anything you learned before, where we can get the money, what is the government policy which is called monetary policy, and what is the fiscal policy? Anyone? Any thought? If you do, rank yourself how much we know. Okay, good. So we know where we up to then, 1 to 5, 1 to 10 on the scale. Or okay, that's fine. So today lesson is content, the keyword. We look around the economics policies, which is very crucial. Fiscal policy, the government policy regarding the investment taxes. Monetary policy is the policy of the central bank in the UK it's called central bank. In other part of the world it's called in the other part of the world it's called the state bank. Interest rate, of course, all these policies, financial and money market, which is we can issue the securities and all. Functional stock is the impact, and then we looking the sources of finance, what those are, where we can money, and what risk involve different sources of finance. So that's all we'll go through today lesson. We have three assessment criteria. We have three assessment criteria: 2.1, 2.2, and 2. Yes, we have a four assessment criteria instead of three. Yes, we have a first is economics environment. So what's come under economics environment? So we'll go through first what's come under economics environment. Anyone knows what is come under economics environment? So key point under economics environment: interest rate, fiscal and monetary policy, GDP of the country, employment rate, balance of, because so many things, we'll just, I'll explain you key terms are balance of payment. So that's the key. When we talking about money market, is means stock exchange is linked with the monetary and fiscal policy as well. Then we have a so that will go through each area we can. Okay. Then we have sources of finance. It can be internal and external. It can be short term and long term. It can be debt and equity. Yes, we can categorize them. That's okay. Each risk is probability. Higher risk and high return. And we can look around each advantages and disadvantages. So we look under each these learning outcomes, we'll go through. Okay, so we'll go through these are the key points, so we need to be really focused, when especially when we'll do assignment, so we can discuss these all points under each learning outcome, which we'll go through further. We'll explain them. Okay, so economics environment, I just summarize everything here in this little mind map. What's come under economics environment? Financial market, which is stock exchange, where how the finance work, which can be different institutions involved in it. Micro mean big economics environment is the objective of environment, like increase, decrease the interest rate. There is an objective behind to boost the economic activity. Monetary policy is a policy of the state bank, which is set increase and decrease the interest rate when it's called base rate. Base rate we call basic interest rate. So in the UK, we have a basic interest rate 0.01% at the moment. You can say it's nothing really. Then we have a fiscal policy. Okay, fiscal policy. As I mentioned earlier, this is about government investment, taxes. Yes, in which sector they will invest, how much they will invest. So they deal with the budget. So that's the fiscal policy of the government. Monetary policy is about the interest rate increase and decrease, and it's also look around the bank's reserves. So that's the key is the government intervene. Yes, government pass the laws to intervene or put the restriction on certain sector if they're not performing, like we learn about the corporate governance in lesson 1. Okay, monetary policy is the management of the economy by the government in such a way as the influence performance and the behavior of economy as a whole. The principal objective of microeconomics policy is to achieve the following: full employment we want. We want the price stability. We want economics growth. We want balance of payment. We want equilibrium and appropriate distribution of income and wealth. So the good economics policy of any country is based on the full employment of the resources applied in the particular labor force. The aim of both full and stable employment. Price stability means the little or no inflation putting an upward pressure on the prices. Economic growth measured by the change in the national income, like that we have a GDP. So GDP means gross domestic product. We saying this country has the high GDP. So we can compare by country. If we look Norway, if we look Malta, if we look um, Qatar, if we look Saudi Arabia, or if we look Libya, if we can look around various other part of the world, so we can compare which country have a high. So high GDP represent that country is economically strong. There will be more employment opportunity, and their standard of life will be better. Yes, so that's we need to be look around. Okay, any question anyone here? If you have a question, please carry on asking. In order for economics policy to work, its instrument must have the impact on the economics activity. So this means it affects the business sector. It does so in two broad forms. Microeconomics maintain the stable aggregate demand. Aggregate demand of what? Help to business plan, investment, employment, or output. Influence cost method include the exchange rate that can influence monetary policy to maintain them, and the fiscal policy is about the taxation. So we do. Okay. Then when any country's monetary policy should reflect and meet the needs and the expectation of the various stakeholders. So shareholders, the steady flow of income, possible capital growth, that's really want. It's a capital is required to grow. Shareholder will expect to rise the dividend stream. Customer satisfaction needs to be achieved through the providing value for money or the value for goods. That's the fiscal policy help them. So supply paid promptly by the companies. Finance finance provider ability to pay, yes, the firm ability. So these, the fiscal policies impact. So when we looking, intermediaries can play a key role key role in the fiscal policy. Intermediaries are the banks, like a clearing bank, insurance company, investment trust. So they can implement. Government, of course, set the policies, and they all other institution, if they work together, and the government objective can be achieved easily. So investment and the merchant bank, finance company, these are all, yes. They also provide the credit. Okay, so to understand all the concept, I copied the link here. Guys, let's go back to our this link. So if we'll look around in this link, so we have a lot of discussion about economics policies, intermediaries, and we can further move to the role of financial markets. Like we discussed, the financial market is about the both the capital and the money market are the place where they require the finance and can meet with those able to supply the units, and the primary and secondary market. Primary market, where first time we sell the securities, and the secondary market. So you will see the explain here. So primary market provide the focal point to borrow and lenders to meet, and the secondary market is a second hand security, like the different brokers. So we can diversify, we can shift the risk, we can hedge mean the foreign currency can fluctuate, so we can pay money to the bank and we can hedge it. Okay, arbitrage theory we also learn about in another unit. Arbitrage is a process of buying a security at the lower price in one market and subsequently selling in the another market with a higher price, so we can earn the profit. Then we have a capital market, so you will see where we can sell the shares, and then money market, where the shares of bonds and things happen, and the sources of finance. Yes, so these are sources of finance which will go through equity and other finance. We can generate internally through return earning. We can issue equities, which is external shares, and that's a capital market. Yes. Okay, then other can be overall. So if we look others, short term and medium term, hire purchase and leasing, trade creditors, overdraft, this is known as money markets. Money market itself, source of medium and short term finance can be from the money market. Okay, so and they are all about short term and long term. Short term, medium term, and short term 1 year. Medium term can be, it varies industry to industry. Then we have an international capital market, euro money market, euro bonds. So these are all sources of finance as well. That's which we'll go through in my slides as well. But you will see this is the quite good. So when we will prepare assignment, so we can use these. The link is quite useful. Any question, anyone? So that's why I not make many slides to restrict my slides. So I just gave you the link here. Okay. Next when we're looking the monetary policy, so we're looking the aggregate demand. Aggregate demand is the total demand for the goods and services in economy. The national income is AD, aggregate demand, that has satisfied the provision of the goods, and the broader thrust of the microeconomics policy is the influence level of aggregate demand. So if the level of aggregate demand will increase, then of course in the economy we will produce more goods. Yes, then we need to be look around, so we need to be make sure aggregate. So that's why the government carry on changing its micro so through if the AD, aggregate demand, is a lower, unemployment might be result. Unemployment will be higher because the demand of the goods is lower. People will produce the less goods. So ultimately, when people will produce the less goods, so we need to be make sure. So we need to be make sure we meet these all, the condition, and the help, to achieve the full employment in the country. That's the crucial. Microeconomics policies also influence the cost of the business. So its effect on the tax exchange rate due to the microeconomics policy, taxation, which is part of the fiscal policy, involve the use the taxation chain in tax rate, structure taxations. So we have a tax rate at the moment. First 12,500 is a free. You don't have to pay the tax, which we call personal allowance. After this, if anything we earn up to 37,500, we have a tax rate equal to 20%. And if anyone earn more than like 37,500 to 150,000, the tax rate is 40%. And then we have, after this we have 45%. In other part of the world even goes even 50-70% as well. So that's, the tax. So this affect, the taxation policy. So government can increase, decrease this free amount limit. This affect the government income. And we have a basic interest rate which we set 0.1%. So if you borrow and deposit money, that can affect. So that's why it's a crucial. Okay. Then we look around, we need to look around. It is clear the money is a crucial. Money is, so the government. So it is clear government want to be more the modern economy function. So money is the financial asset at the liquidity and fulfill the task as a medium exchange. So monetary policy is concerned with the influence of overall monetary, how much supply, how many notes we need to be print. That's also crucial in the monetary policy as well. Because if your monetary policy is good in the country, of course you're not producing, there won't be inflation, your currency will be stronger. And we need to look around all these different, we need to look around different variables, huh? So that's why it's crucial these things in the monetary policy we review. Okay, next we looking the what we have in the monetary policy. So in the monetary policy, other things we need to look around the stock money, how much money, supply and demand of the money, which I just mentioned you earlier. So is the supply of the money, we need to be look around very carefully. So if you're high money, the demand of the money will be lower. We learn about the law of demand and supply. So law of demand and supply, it shows, how much is the demand, how much is the supply of the money. So if it's a too much currency, you printed too many notes, what will be happen? The exchange rate and the power of the currency will drop. So you have to make the decision, the power of the currency. So like China, they kept the very low value, even they have a reserve more than in UK, and up to some extent we can say, because the reason is China is industrial state and they have a billions worth of reserves. So that's why, so China economy is so strong. But on the other hand, so if China will increase and they keep the currency value equal to the pound, we not going to be buy the goods from China, and will say the goods will become expensive in a way, because the reason we buy things again, the exchange rate is lower in China. Why people come to maybe UK in term of, because UK manufacturing is less using, service industry is more, so that's why UK kept higher pound value. And because we can buy things from other part of the world with more goods because due to the higher value. So we need to be look around the measurement of the supply of the money. We need to be look around the narrow money measures is note and the coin in circulation with the public till the money held by the banks, operation of the balances. M4 we can look around broad money measures. So these are different measures is we can take through the fiscal policy. Then we have further measures. Sorry guys, this my, I don't know why slide is not okay. So we need to be look around these. So we need to be make sure we have the effect of the interest rate. We could understand, because before increasing and decreasing the interest rate, it has impact, so we need to be look around all the impacts of increasing and decreasing interest. So when high interest rate, so depositor will get more, and they prefer to be deposit money in the banks instead of investing money in the businesses. When we have a low interest rate, so then the borrowing will be cheaper, and the people will, instead of even deposit money, they will prefer to be invest money in the businesses to generate more money out of it. So that's why we need to be make decisions, so which one is best for our economy, because there is a no hard and fast rule. If the good in the UK, it will be good at everywhere, because that's why we have an important quotation: think globally, act locally. So these all the factors we need to keep in mind. uh, the debt interest rate effect on economics growth, how much borrowing, what is the GDP, what are the growth rate, what is the inflation we have in the country already. Inflation mean persistent increase, persistent increase in the price index. So that's we need to be keep in mind to make sure we not stay behind, in terms of the international competition. So that's why government can play a huge role, increase and decrease the interest rate. So we need to be make sure we'll carry on regular reviewing these. If we not review it, so we'll really struggle, So that's why is all these monetary policies benefit of doing monetary policy. Any question, anyone? Did we get the purpose of monetary policy? Okay, any question if you have, please? Okay, so we need to be make sure we need to go through these. Okay, next we're looking to monetary policy, fiscal policy, financial market, capital market, and the government policy. All we discuss under that, and I copied the link for you as well to for further reading, which I'll explain you. So next we're looking the sources of finance. Often the hardest part of the starting the business, raising money. Where you raise the money? So if you want to start a business, you want to be make sure where the money will come from. If you're a sole trader, your own. If you're a partnership, two and more partners can bring it. If it's a company, you can issue shares to the. So that's why. So at the startup cost, we need to look around. We need to look around the investment capacity in the fixed asset, how much money we have. We need to look around the running capital to pay the salaries to the people, or the company day in and out expensive. So what we need type of ownership. If you want to start a business, you can sole trader, partnership, limited company, or the non-profit organization. We have to set missions, visions, values, and corporate objective. Working capital cycle. Always we need to be look around the debt. That is how quick we receive from the customer, how quick will pay to our suppliers, and how quick we convert inventory. So trade receivable days plus inventory days minus trade payable days is give us one working capital cycle. So that's known as working capital cycle, which we'll go through some point, more these things in ratio analysis. It's called financial ratio. So that's we need to be well aware of. Okay, next we're looking a business has the variety of the choices. They can raise money, amount of money required, how quick money needed, and the cheaper option. We always look, so which one is is a cheap option. So like payday lender, if you go and you don't have your own money and you go to the shops where you can borrow the money for short period of time until you get your salary, maybe they charge even 200% interest on some, or can be 30, 40, 50, 60%. If I'll borrow £200 for 10 days, maybe I have to pay around 60, 80 pound just base interest for those days. So if I don't have my own money, I'm really with in these countries, especially in the developed country, people are really stuck. So we have to make sure we manage our money properly. So the base rate we have 0.01. It can be goes increase it in some country we have a 10%. So it's affect the cost of borrowing. So always we need to be look around. Then we need to look around the tax policies in that country. So amount of the risk involved, the reason for the cash, the project has a less chance of leading profit. It deemed to be more risky if we have a more yes. So we need to be managed interest, and if the requirement of the finance, good entrepreneurial is just whether the finance needed is for the long or the short term. That's we need to be make sure we do. Okay. Then Okay, then short-term source of finance, long-term source of finance. So short-term, we can do overdraft, we can get the credit from the supplier, or we manage our working capital. So that's the way we can. And the long-term, of course, we can get the bank loans. So these are the main long-term sources of finance: mortgage, bank loan, share issue, debenture. Debenture is sort of, you have an asset, you don't have a money, you can secure it, you issue the one paper, and that's called debenture. Return profit is the profit of the previous year, we can use it for the long project. Higher purchase, we can buy the goods or cars on the higher purchase. So that's we can look around. Okay, then when we do, we need to be appraised the which source of finance is the best. So that's we need to be make sure we'll do. So that will help to be monitored which one is the best. Like our draft is good for day-to-day expenses and the cash carry on coming, and if we are short, we can use it. We can make arrangement with the bank. Okay, then working capital is the capital available to conduct day-to-day option, and normally excess of the current asset about the current liability, that is working capital. So these are all the thing: inventory, receivable, cash, current assets, required funds, payables, bank overdraft, current liability. Current liability mean the liability which we have to settle. So then if you look the key sources of business finance: long term, medium term, and short term. So these are all. Factoring is meant by you have invoices, you give to somebody the invoices you're supposed to receive, and you can generate the money. I have added few slides, so I'm not going each slide word by word, but I'll go explaining you overall the concept of, so you can understand. The bank overdraft, of course, easy. It's the advantage to meet the current, but interest rate can be slightly high, so that's why it's not a good option for the long term. Okay, then we have a borrowing from the bank. Is a clearing bank, retail bank, merchant bank can be, and we can borrow money from them. And borrowing money can be, bank will lend you money only if they have repaid within the reasonable time. So if we have a good credit scoring, the bank will give you the bank loan. When we look, and then we can go through the partners. So if we are a partnership, you can add additional partner into business, and they can bring the money that doesn't have to repay, and no interest involved. Diluting power, maybe that we need to share the profit, we need to share our control of the company, that can be a disadvantage as well. So when we look next, external shares issue, this is the source of finance suitable for limited company involving issue more shares. Long term source of finance, that's we need to. Sources of leasing, we need to look around the lease. We'll go, or we don't go, the lease is long term, which is a cheaper source as well, but can be disadvantage. Business can have a use lease, but they can be expensive as well. The asset belong to the finance company. There are two types of lease: one finance lease and operating lease. Finance lease mean if you pay money, if you buy asset with the repaid as well, at the end of the life of the asset will be yours after all the payment. But if it's the operating lease, then it's like a rent. You carry on paying, you carry on using. Okay, so these are different sources of fund. Mortgage, of course, we know the mortgage we can. At the moment, the mortgage have a different rate: fixed rate, flex rate, the rate with chain with the basic interest rate. So these are the rates is prevailing at the moment in the UK. It can be 2.5. It depends upon credit scoring, depend upon different product is offering. Okay, then we have a trade credit. Credit we can get, from the supplier, buy now and pay later. That's, as the advantage. It mean, we don't have a cash, we can buy asset, and but it can be discount. The cash payments will be lost, so that's we need to be make sure we have advantages and disadvantages need to be measured before. So typical trade period is a 30 days and trade credit source of finance. So that can be high interest rate even. So government grant, that's the good, government grants can be available, but it depends which area you set up the business, government grant, and always good to be look around these. Venture capital, various venture companies come together and then they invest, in the various projects. So we need to look around the risk as well. So because a lot of control and a lot of national security issues can be because the various foreign venture capitalist company, they have their own incentives, some political incentives as well. That's why they want to be the finance purpose, time, amount, and ownership, and the size of the business. So you need to be keep in mind these to make the decision. Then sources of finance, we can look around. We can divide into equity and debt financing. So equity mean issue shares, and the debt mean you borrow different sources like overdraft, like a leasing, like a mortgage. So this is so equity long term normally because internal generated return earning can be used. Ordinary shares, long term debentures, preference, medium term leasing. So these is the money market as we mentioned earlier. Okay, then when we go through issue shares more, and this can be affecting the old shareholders and the voting rights and the power of the shareholder, which is we call critical X price. So we can look around how this will affect on the value of the share, like the shareholder. So debt versus equity. Equity shares on the business and have the voting right. The debt holder have a priority payment. So risk, debt is low risk for the debt. Yes, debt holders higher risk for the company, and the equity higher risk for the shareholder and low risk for the company. So you will see the different source have a different risk. So debt holders will accept the lower return due to the lower risk, the cheaper for the company, and equity if the shareholder want higher return for higher risk and more expensive for the company. So you have to make the decision according to Miller, Maldiani, and various other models, which will go through in the next, lesson as well. So that's we need to be keep in mind different theory. So financing to small and medium sized organizations. So you have to look around the different source for each type. How this affect the weighted average cost of capital. So how much is the cost of equity? How much is the cost of debt? How much balance we need to be? What overall average cost will be? So maybe you issues uh, 5,000 you generate through shares and 6,000 you generate through debt. So you required 11,000 or 12,000, 1,000 you have your own. So you can look around the average cost of it. So if the average cost is lower because the debt is cheaper than equity. Always need to be remember the key word, debt is cheaper than equity. Debt mean the loan. The equity mean the shares. Okay, so I copied the link to watch the video, which is to dwell further understanding about the sources of finance and economics and the situation. So please, you just copy this link and you can watch. I copied the article links, good to be read, please. Sources of finance, so you can copy this ACCA, which is quite good to read these articles, further enhance your understanding. I copied the link, to do the quiz. So please, guys, I'm not playing the quiz because it's good to be you do your own. It's a good own reflections. Yes. So always good to be do your own reflection. So at the start we were four, and you can look around end of lesson. Are you five? You learn something. We learn about monetary policy, the policy of the central bank. We learn about fiscal policy, is the policy of government. We learn about the base rate, which is called basic interest rate, which is set under the monetary policy by the government, under the monetary policy by the central bank, which in other part of the world is called state bank. We learn about the sources of finance. We learn about internal, external. We said debt, equity, and the debt versus equity financing, and they will we learn about the debt is cheaper than equity. So that was the key message or the buzzwords, for this lesson. So please complete the required activity and do do background reading. If you have any question, drop me email and I'll try my best to explain you further and go through. So thanks for listening, and I'll speak you next lesson and we'll go through our LO3. Thank you. Bye bye. Any question?